What happens when hedge funds lose money? Hedge funds are a type of investment where individuals contribute money to a fund and these loans are then invested in companies. In turn, the hedge fund managers will provide their investors with returns from the investments. However, this type of investment is risky and investors should be aware of what happens when they lose money. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now and subscribe to our channel to be notified when new videos are released. Hedge funds have been known to have a history of losing money. The losses have been attributed to many different reasons, including poor risk management and too much leverage. Investors in hedge funds put their capital into the fund with the hope that it will outperform the market over time because it is not regulated by government agencies like other types of investments, such as stocks and bonds, are regulated. In September 2008, the U.S. government introduced an amendment to the Dodd-Frank Wall Street Reform and Consumer Protection Act. Banks and credit unions were required to maintain a certain amount of cash on hand in order to use in case of emergency. This change has resulted in less capital and liquidity available for the banks and credit unions, meaning they need to allocate more money into equity or debt. Most hedge funds are expected to be leveraged with debt. This means that when the fund does poorly, the funds are in danger of defaulting on their loans. If the hedge fund does not follow through this repayment, there is high chance that they will not be able to access fresh capital in order to continue providing services to the investors. When hedge funds really lose money, investors can lose up to 30% or more of their investment. This can result in a devastating effect for top-performing hedge funds who may find it difficult or impossible to continue providing services for clients and investments. Hedge fund firms trade in large amounts of financial securities and other assets and employ a wide range of strategies. Hedge funds can be classified into two categories: managed and unmanaged. Managed hedge funds offer their investors the opportunity to share in the profits, while unmanaged hedge funds allow investors to invest in a fund with the expectation that they will receive a return, but without providing any management or oversight. This is because managed hedge funds are not allowed to operate for profit, while unmanaged hedge funds can operate for profit. Hedge funds are known to be more volatile than traditional mutual funds because they take more risks and use leverage, which means that they can borrow money on terms that are better than those offered to traditional investors. Investing in hedge funds is an alternative way of diversifying one's investments and making a profit from a volatile market. What are the main components of a hedge fund strategy? Hedge funds are investment funds that typically use complex investments, such as derivatives and other financial instruments, to generate returns. There are three main components of a hedge fund strategy: A, a long position or a short position; B, a return on assets invested; C, an exit strategy. Hedge funds typically use an exit strategy to either sell their holdings or liquidate the fund. Some hedge fund strategies require a combination of both approaches. How does it work when a hedge fund loses money? In a hedge fund, investors typically put money in with the expectation of earning a higher return than what is available from public markets. When a hedge fund starts making losses, it can have a serious impact on the financial well-being of the investors and the company. The loss of capital can also cause problems for other companies in an industry if it is not managed properly. When hedge funds make losses, they usually face three types of consequences. 1. Liquidation. When an investor has to take their investment back after they have lost more than their original investment. 2. Forced liquidation. When an investor's capital has been locked up in illiquid assets that cannot be sold. And 3. Forced closure. When a hedge fund manager has failed to meet their performance obligations. Forced closure is most often used in the context of a short-selling strategy, as the manager will be forced to close out their positions at a loss. What happens when hedge funds go broke? Hedge funds are usually managed by experienced investment professionals who have the experience and expertise to manage large sums of money. While hedge funds have been around for decades, they have only recently become extremely popular. What happens when these funds go bust? What is the impact on the investors? This is what we aim to find out in this video. The Great Financial Crisis of 2007 was a turning point of events that had a significant impact on the world economy. It was deemed as one of the top financial crises by many experts and scholars, and was followed by a deep recession that lasted till June 2009. It also had many negative effects on society, such as high unemployment rates, high inflation rates, reduced trade volume, and reduced growth rates in some countries like America and England. How does hedge fund loss of money affect the financial sector? Hedge funds play a key role in the financial sector and the economic growth of a country. However, hedge funds face some significant challenges as new global regulations come into play. The loss of such funds will trigger some major changes in the market, as these funds ensure that they are diversified and do not hold too much on any one company or project. Hedge fund managers are required to be diverse by investing in many areas of investments, such as stocks, bonds, and commodities. For example, during 2008's financial crisis, hedge fund managers were forced to sell stocks and other securities, which led to a steep decline in their value. How hedge funds lose money and don't count the costs. The hedge fund industry in the United States is estimated to be worth $3 trillion in annual revenues. Unfortunately, hedge funds aren't profitable for businesses and individuals that they invest in due to fees and expenses. This has led to a lot of criticism towards the industry. One such criticism is that hedge funds do not count their costs when they calculate profitability. This causes losses for the investors and businesses. Which hedge fund lost the most money in 2020? With the recent market crash 2020, many hedge funds have lost significant amounts of money. While some hedge funds recovered their losses, others did not. The worst performing hedge fund is currently Longleaf Partners, which lost $6 billion in 2020 alone. Here is a list of the largest hedge fund disasters, starting with number 10. Merino Capital, called Marin Capital. It had $1.7 billion in capital. It used complex financial strategies, including credit arbitrage and convertible arbitrage, to bet on GM. Credit arbitrage allows corporations to transfer payment default risk to hedge funds. Convertible bonds are issued in convertible arbitrage and can be converted into stock. These are low-risk tactics unless if the stock price drops drastically, as it did with General Motors, leading to the fund's liquidation. 9. Ammon Capital. Ammon Capital was projected to be a prominent hedge fund in Singapore, founded by derivative traders from UBS Group AG. Investors lost faith in the fund, and it closed in 2005, barely 2 years after its establishment. 8. Amaranth Advisors. Amaranth Advisors is the next biggest hedge fund disaster. Even if a hedge fund tries hard, it can get sucked into a terrible deal that destroys it. Using convertible bonds, Amaranth, which managed roughly $9 billion in assets, generated returns of around 86%. But big derivative bets failed, and the fund lost almost $6.5 billion. 7. Pequot Capital. Pequot Capital grew rapidly in the early 2000s, managing assets totaling at least $15 billion. The hedge fund was fined $28 million in 2010 after it was determined that insider trading was responsible for the excessive returns. 6. The Galleon Group. In 2009, the Galleon Group managed $7 billion in assets. However, its owner, Raj Rajaratnam, was sentenced to 11 years in jail for insider trading and fraud, and at least 50 others were convicted or pled guilty in connection with the scheme. 5. SAC Capital. Steve Cohen ran SAC Capital, which formerly managed at least $50 billion in assets. From 2011 to 2014, numerous traders were accused with insider trading, and 8 former workers were convicted, contributing to the downfall of a worldwide hedge fund powerhouse. 4. Atticus Global. In 2007, Atticus had over $20 billion in assets and strong returns, but it was one among the many victims of the 2008 global financial crisis, and it had to fold in 2009. During its term, it returned approximately 20%, roughly 16% more than the S&P 500 index. 3. Tiger Management. Julian Robertson founded Tiger Management with $8 million, and it grew to $7.2 billion in 16 years, making it the world's largest hedge fund at the time. A significant blunder, basically shorting against tech businesses with little intrinsic value, was required for the hedge fund to make the list of the largest hedge fund flops. As a result of the dot-com bubble, the fund suffered substantial losses and was shut down in 2000. However, Tiger Management continues to function as Julian Robertson's family business, and many of its workers have gone on to become highly successful hedge fund managers on their own, dubbed Tiger Cubs. 2. Long-term capital management. Long-term capital management was created in 1994 by John Meriwether, a former Salomon Brothers fixed-income arbitrage head who hired 2 Nobel laureates, Myron S. Scholes and Robert C. Merton. Nonetheless, long-term capital management lost approximately $4 billion in 1997 due to huge crashes in Asia and Russia. The fund was bailed out by the federal government since its closure would jeopardize the stability of its creditors, which included large banks. Nonetheless, it closed in 2000. 1. Madoff Investment Securities. Madoff Investment Securities, managed by Bernie Madoff, topped the list of the 10 largest hedge fund collapses. Bernie Madoff, a powerful figure on Wall Street, ran the largest hedge fund at the time. He would simply accept money and say he was investing it, while keeping it in his own bank. On the other hand, he would claim phony earnings that the investors would accept without inquiry, with the same investors paying taxes on them. In 2008, Madoff realized that the responsibilities were far too large to pay off, and he confessed to his sons, who denounced him to the authorities. The fraud was estimated to be worth approximately $6 to $5 billion, and Bernie Madoff was sentenced to 150 years in jail and restitution of roughly $170 billion. The world's largest hedge fund turned out to be a glorified Ponzi scheme, defrauding investors of tens of billions of dollars. Conclusion: understanding what happens when hedge funds lose money is essential for future investments. As I mentioned earlier, hedge funds are highly specialized investment vehicles that provide capital to risk-taking entrepreneurs and corporations. Hedge funds are often seen as a riskier, more speculative investment than the stock market, but they generally generate higher returns due to their ability to trade around the clock. The hedge fund industry has seen an influx of new investors in recent years, causing hedge fund managers to become vulnerable to short-term volatility. As a result, investors should understand what happens when hedge funds lose money, so they can properly manage their investments in future. As the popularity for investing in hedge funds has increased over the years, it is important for future investments of individuals and companies alike to understand what happens when hedge funds lose money, so they can avoid unnecessary losses and maximize gains. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.